This is Matthew Cratter's Bitcoin University. Today I want to talk about whether it makes more sense when you're getting into Bitcoin, whether you should dollar cost average in, or whether it makes more sense to hit the smash buy button. In other words, to do a lump sum investment up front. So you finally figured out why you need some Bitcoin. There are always some very good reasons. For example, Bitcoin is censorship-resistant money. In an age of censorship, debanking, and deplatforming, no one can stop you from sending it, receiving it, or storing it. Also, Bitcoin protects your savings from cost of living increases. Bitcoin cannot be debased by bankers like fiat money can. Bitcoin preserves your purchasing power much more effectively than stocks, bonds, or real estate today, tomorrow, and well into your retirement. You want to buy some Bitcoin and you have a chunk of change you'd like to put into it for these good reasons. And so then the question is, should you do a lump sum purchase? You buy it all at once, in other words, a smash buy, or should you DCA in, dollar cost average in other words, buy a fixed dollar amount of Bitcoin every day, every week, or every month and slowly into your position that way. As I've said many times on this channel, whenever I get some spare cash, I immediately dump it into Bitcoin without even looking at the price of Bitcoin, whether we're in a bull market or a bear market. And that's because I think that Bitcoin is still really cheap at anything under, call it $500,000 per coin. It's just a complete no-brainer at that point. And also because I think that's far more risky to hold on to that cash, to leave that spare cash sitting in a bank while I dollar cost average. It's far more risky to leave it in a bank, I think, rather than park it immediately in Bitcoin. The problem with money kept in a bank is constantly losing purchasing power. And to make matters worse, banks are all fractional reserve. They don't have enough money to pay out all the depositors at once if they were all to ask for their money at once. Also, banks can close for weeks or even months on end in the event of a war or other crisis. Banks can freeze your money for months or even years, and there's little that you can do about it. Even in the U.S., this has happened in the 1930s. The banks closed after September 11th, for example, and then things have been much worse in countries like Lebanon, for example, where people have had to rob banks to get their own money back. Banks have begun freezing accounts linked to truckers. This was back from 2022 in Canada. So we know that banks are not always the safest place to hold your money. So that's the reason why I personally just hit smash buy whenever I have some spare cash, rather than leaving it at a bank and dollar cost averaging into Bitcoin. If you're finding this video interesting so far, I just pause really briefly here to ask you to help to support this channel's educational mission. Hit the subscribe button, that does really help. Leave a like, leave a comment, question, suggestion for a future video, and share this video with a friend or family member. So that's why I just hit smash buy whenever I have some spare cash. But is hitting smash buy the optimal way to accumulate Bitcoin? I'd always wondered up until this point, but fortunately the guys at Bull Bitcoin have crunched the numbers for us. And if you're looking to buy Bitcoin, I'm not affiliated with them in any way, but if you're in Costa Rica, if you're in Canada, or if you're in parts of Europe like France, for example, you should use Bull Bitcoin to buy your Bitcoin. But what today we're going to be talking about their analysis, this article they wrote, all in an analysis of smash buy versus DCA when buying Bitcoin. And they begin by saying, over the years, many have recommended DCA, dollar cost averaging, or over lump sum investment. First, because they consider it safer for newbies likely to get shaken by Bitcoin's wild volatility. Second, because newcomers are notoriously bad at timing the market. And lastly, because DCA, dollar cost averaging, is considered to deliver better performance over the long haul. While there's no disputing the first two claims, we want to properly assess the veracity of the latter. They go on to write, financial markets are rarely ergodic. The average return of an investment held for a year isn't the same as the average return of 365 investors holding it for a day. Investing exhibits path dependency. Your specific journey matters, shaped by the sequence of gains and losses. In other words, starting points and ending points really matter for this kind of comparative investment analysis. The article continues, quote, to avoid such a pitfall, we analyzed every possible DCA and lump sum investment from January 1st, 2016 to May 13th, 2025, and averaged their performance across all entry and exit points. We focused on weekly and monthly DCA with a minimum holding period of 1 year, resulting in about 4.7 million different portfolios for each investment frequency. This approach shifts the focus from arbitrary entry and exit points, which can be cherry-picked to favor either strategy, to variables like investment frequency or duration. By doing so, we gain a clearer, more reliable understanding of each strategy's performance, capturing the path dependency of that traditional analyses often overlook. So let's look at the results they came up with over this period. Again, this was from January 2016 to May 13th, 2025, and they looked at every possible entry and exit point to come up with this data. Monthly DCA, in other words, dollar cost averaging once a month, came up with an average return of 333.41%. Weekly DCA had slightly lower returns at 325%. And then the lump sum investment had very high average returns of 1,738%. If we look at the CAGRs, call it 42% for monthly DCA. Weekly DCA was very close to 41%. And then lump sum investing, in other words, you put all the cash in at once, as I've been doing, it gave you a much higher return, almost a double in terms of the CAGR at 82.47%. But we can see here these higher returns, these lump sum investing returns, came with much higher experienced volatility. In other words, much higher standard deviations, both of this average returns and of the compound annual growth rates. So the standard deviation was over 3,000% for lump sum investing. And for weekly and monthly DCA investing, it was much lower, almost a tenth, a little more than a tenth, so 437% standard deviation for monthly DCA, 425%, 426% for weekly DCA. And we can see likewise for the compound annual growth rates, the CAGRs, the standard deviations of lump sum investing was approximately twice at 102% versus 51% for monthly and weekly DCA. And so you get much higher returns with lump sum investing, but it does come with much more volatility of your holdings. You'll have bigger drawdowns, and psychologically it'll be much more difficult to hold. In conclusion, lump sum investing, in other words, hitting that smash buy button, will give you much higher returns on average than dollar cost averaging, but dollar cost averaging is much more comfortable from a psychological perspective and will still give you high returns. And the fact that it's comfortable may mean that you're able to hold on for longer. So this is something to consider. When you're dollar cost averaging, you're happy when Bitcoin pumps because the value of your Bitcoin that you already own is going up. And you're also happy when Bitcoin dumps because you know that you'll now be able to buy more sats at these lower prices than you could at higher prices. So whether you decide to smash buy, lump sum invest, or DCA, or you do a mixture of the two over time, probably doesn't matter too much. Don't overthink things like this. The really important thing, though, is just to get off of zero and start buying some Bitcoin. And then when you've accumulated, at least call it 1 million Satoshis, 1 million sats worth of Bitcoin, in other words, 1/100th of a Bitcoin, and they're sitting there on an exchange, that's when it's time, when you hit that size of UTXO, that's when it's time to withdraw to a good hardware wallet like the Cold Card, because not your keys, not your coins. So if you're doing dollar cost averaging, then wait till you get enough there until you are at about 1 million Satoshis, or even lump sum investing. You can hit the smash buy button, buy 500,000 Satoshis, hit the smash buy button a month later, buy 500,000 Satoshis. It's probably safe sitting there on the exchange, something like River or Strike while you're waiting, or Bull Bitcoin, but then you should definitely withdraw it. I talk more about hardware wallets, for example, the Cold Card, in this video, which I'll put a link to in the description notes below, answering all your Bitcoin hardware wallet questions. If you enjoyed this video, be sure to hit the subscribe and like buttons. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.